Hi friends, in this video I'm going to share something controversial. Here's the secret, your gold is a terrible investment. I'll use data and research to show you why your gold is a terrible investment, 2, how it's a myth that it can protect your wealth, and 3, what can you do to allocate more of your wealth into the stock market. Now, as Indians, we have something deeply ingrained in us. I'm an Indian, and that is that we need to invest in gold and or real estate. This is so deeply ingrained in us. And I get it. With gold and real estate, there's something psychological about it. There's a sense of security. Gold is physical. You can touch it, you can feel it. When you buy it, it's yours. You feel like you own it. Whereas if you invest in the stock market, you are seeing numbers behind a computer screen and you can't really touch it or feel it. So you don't get that psychological safety from it. So let's get right into it. My first data point compares the rate of return for gold versus the Indian stock market. So if we look at this chart, we see that from 1990 to 2000, gold had an annualized return of just 2.8% versus the stock markets, which returned 14.4%. From 2000 to 2010, gold returned 16.3% versus 19.9% for the stock markets. 2010 to 2020, gold returned 9.2% versus 10.4% for the stock markets. So as you can see, investing in the stock market through index funds, investing in India would have given you much higher returns than gold in each time period. So let's move to data point number 2. In India, gold hardly delivers any return adjusted to inflation. So this is why it's a myth that gold will help you protect your wealth. One of the most common mistakes investors make is to ignore 2 key variables, inflation and taxes. Your rate of return needs to subtract inflation and taxes to get an accurate number as to how much your money actually returned. And when you look at gold, adjusted to inflation and taxes, gold hardly gives a return that's comparable to the stock market. So let's look at another chart here. On an inflation adjusted basis, gold delivered only 2% per year. People look at the annual compounded growth rate of 9.35%, are happy, but more often than not, they forget to factor in inflation. So the data is clear. Gold has underperformed the stock market decade after decade by a wide margin. So what can you do? What can you do? What can I do as an investor? Number 1 is to embrace the mindset that investing in the stock market is not unsafe if you are prudent and you know what you're doing. The simple answer or the simple pathway for most retail investors is not to pick individual stocks. If you simply invest in mutual funds through SIP or ETFs or index funds on a month-over-month basis, you will do very well over a long period of time. The second thing we can do is to diversify our portfolios. So if you have a lot of gold already, you can sell some of it and move it to mutual funds or index funds. And third is that to get financial advisor to help us plan. This is not a mindset that we're used to in India. Again, we rely on uncles or aunties or the real estate salesperson to plan for our future, and they don't really know what's best for us if they're not educated, if they don't have a background in finance. So I'd highly recommend getting a professional financial advisor to help you diversify your investments and grow your wealth. I made a video on why your house is a terrible investment. So click on that. You'll also get data points on how real estate can also not be a great investment. If you found this video useful, please hit the like button, and I will hope to see you next time.